Coming to you live. All right, welcome everybody. We are back. This is Startup Brothers number 17. I'm
Let's
Trace.
do it. I'm
Maxwell.
Maxwell.
Yeah. And so we want to start with today's first topic. Definitely a hot topic, so take your temperature. Venture is an interesting space right now. This will always be the kind of topic of choice, but I get a lot of pushback on Twitter when I talk about are you expecting to be $100 million business, $1 billion business, or even bigger? And that's fine. We know that most fail, and it's the outliers that make us all the money. But you still have to stuff these companies full of money, 10 million, 50 million, 100 million. You're seeing these massive numbers. And so a lot of people are asking, hey, what happens if you invest in a company and they pay you out dividends? They give you some cash flow, monthly, quarterly, yearly, some way of getting money back. And I say that's great if it works. It's rare, just like getting a big hit. But that's not the business we're in. We do not take money out of the companies we invest in.
I mean, you should be putting the money right back into it to continue the growth. And to me, what's so funny about a business, and we even see it on the public markets, the Warren Buffetts of the world. How big can I make this bank account that I started? Right? So I have a bank account, and I want to see over how many years can I just make this bank account number go up and up? So distributing dividends almost it defeats the purpose of business per se when it comes to having payouts. But from my founder's perspective, just never let the fuel run out. And if you could overfuel your business, that's what from my understanding, it's all what a business is filling up a bank account.
Yes, or at least not letting it go down. That's where like break even is. And even if you're a little bit profitable, it gives you a cushion. Emergencies happen. Things take longer. You have recalls. You have to hire people. You need to do like a special marketing campaign. You get this amazing opportunity. And so it's great if you can invest in like real estate or some type of more cash flow generating businesses, maybe even usually this happens on the CPG side. That's where we see a lot more of these kind of more consumer oriented ones that are distributing cash back. On the software side, I almost never see it. Generally, they start doing dividends and payouts if they're not going to be as successful, but they found their business that works. They know their unit economics, it's sustainable, and they're growing. So they know they can slowly give investors money back. And the investors will say, yay, this is great. But like deep inside, it's a loss. It is not going to work. And it's just not the big hit. If I get 1x my money back, that's just really unfortunate. And so that's why I tell these people, like, great, if that's what you want, that's not angel investing, that's not venture capital. And I'd rather get all that money back or maybe even take it as a loss and slowly kind of drip money over time. It's great. It's a zombie company. Even like Facebook, they IPO'd, 2010, 11, 12. And just in their last earnings, because they have so much money, their growth is starting to come back. Now they're going to do dividends, right? Because like, what else am I supposed to do when I'm earning $10 billion in profit every single quarter? What am I supposed to do with it? Give that to my shareholders, drive back up the stock value.
I mean, it seems like there's two perspectives, and I'll tell you that. If I'm lucky enough to have a business that is happy enough and healthy enough to give dividends while growing, right? So breaking even in many cases is appropriate because that means you're investing into the company, but the value of the company is going up, right? So if I could give dividends, that would be that means you're in a relatively excellent position, right? And of course, investors would say, if I only got 1x my money, I'd rather you just keep my money and keep growing.
Right. Keep it all for yourself.
Yeah, and then, we all know what the dividend stocks are. They grow 4 to 7% maximum a year, if not a little less. But that's why they're dividend stocks. They're not going anywhere. These are monster, massive companies that might have not plateaued, but they're not a hockey stick and they're not anything more than a 10% growth angle.
Right. And so how do we make our money? I tell people our liquidity is at the exit. What's an exit? It's 99% M&A, which is acquisition, and 1% at the most an IPO. IPOs make the headlines, and those are generally the bigger numbers, the billion, 10 billion, 20 billion. And, well, you get a little bit crazier. We're past Zerb, where Rivian went at 100 billion. That was ridiculous.
Now look at it.
I think they're now worth maybe 10 billion. But there was a chart, and we were debating it on Twitter, that basically shows that the majority of companies get acquired after a Series A. So what does that imply? That
Yeah.
you've raised maybe 10, 20, 30, 50 million, depending on how hyped and how popular you were, and your valuation may be worth 100 million. So if you're getting acquired after that, the average exit, I don't know, is what, 75, 90, maybe 100 million, kind of skewed, depending if you're putting in like fintech, bio, healthcare. But generally, acquisitions are smaller, and unfortunately, on the bigger side, as we discussed a few podcasts ago, that Figma tried to get bought for 20 billion, iRobot for 1.5 billion by Amazon, Harry's was denied, and it's just going down the list of all these companies that are getting denied. So right now, the lifeblood, the liquidity of our entire industry, which is not just VCs, but it's double sided, or even not even how many sides. Let's see. The VC, the GP doesn't make money, which means the LP that gave them money doesn't get any money. The founders don't make money, so they might not start another company, or they
Yeah.
might not keep investing. And then the employees don't make any money. And when you have employees who become millionaires that have been working really hard for 5, 10 years, they really seed the industry. And so that's what we're really hoping for. We'll see. It's election year. Generally, it's a little light on M&A and IPOs. Look, Reddit's up a little bit. So that's looking good right now. We'll see where it goes, because it's always about the first earnings when the lockup expires, or the second earnings after 6 months.
Yeah, it's a double-edged sword, right? The liquidity is great for everyone. I mean, we know angel exhaustion is as real as it gets. Everybody becomes an
Oh, yeah.
angel investor. I invested in a startup, and we know literally 99% of the time you're burning your money. But it gives you something to talk about at dinner in many cases. So the founders that are still locked up, the employees that are still locked up, the GPs that are still locked up, can't deploy capital, their intelligence, and their hard work elsewhere based off of some government agency or somebody at the top saying this might create a monopoly or it's inappropriate for you guys to merge. We've all heard of Bell Atlantic or AT&T a million years ago. That's the major famous one where the government said break up into different sections. And we'll do a different report on that. It seems to sort of create competition, which in the long run, the whole point of this is that us, the consumers, end up winning because competition makes the companies try harder to win your business and of course balance how much these services cost. But what you're getting at is these are going only through two institutional rounds, right? So really it might
Yes.
be three rounds, but two institutional
Yeah, right.
ones,
Pre-seed, seed, Series A. Yeah.
right? I remember one of my friends exited his business and they said, what was the greatest thing about exiting your business? He goes, making my friends and family millionaires, the ones that believed in
Right.
me in the first
Love
round. So
those that love you first.
yep. So friends, family, and fools round is that first round that's not institutional, but that could feel really good at an exit.
Right. And to your point, though, about the second or third institutional round, so it's kind of that catch 22. If you know that you only have to raise 2 rounds to kind of exit,
Yeah.
it kind of changes the dynamics, because as a family office, as an angel investor, my job is to invest in a company that can raise more money. And then they're investing because they can raise more money, because it's kind of markups, but also you need that money for growth and to go higher, money each time, unfair advantage. And as you keep raising money, you keep building and building, and you get to that $1 billion. Hopefully, not a $1 billion valuation. We want that. But once you hit a certain plateau in terms of valuation, you eliminate 90+% of all companies that can acquire you. So you're right. You're
Yeah.
back to the same Facebook, Google, Amazon, Oracle, SAP. Like, all the same companies are the only ones acquiring, and they can't now. So as we also said, right, like Microsoft basically was like, all right, if I can't acquire you, I'm just going to take your founders and your assets, and we'll deal with it later. I'm worth $2.5 trillion. Like, boo hoo. Like, you raised $1 billion. 1 week later, I made $1 billion. So that's what's scaring a lot of people right now. That's why everyone's investing in AI, because that's where we think that the exits will be, even though we're investing now for years out. And
Yeah.
AI will be ubiquitous, AI for X or AI for all. And we're not technical. Most of my friends aren't technical, at least from a venture perspective. And even if you slightly were, like you're a coder, how are you supposed to look at these LLMs, these databases, and really kind of evaluate all this AI, right? If you're not a technical founder building AI, and I'm not a technical VC investor to check out, It's just great. I believe you. You're a rapper. This could work. And maybe that's something that someone wants to acquire in the future if you find a nice niche. But a niche could be small, it could be big. That's what's really difficult right now and why everyone has kind of slowed down on all of their investments, but are kind of feeling maybe a little bit safer now.
And people slowing down on their investments for a few reasons. One is investments are funny at the moment. And,
It
the shiny object in the room, as we mentioned before, is taking all the air out of the room when it comes to investment. It is soaking up most of the investment. And then
is.
I feel like, the game of risk has changed. GPs, I mean, LPs are putting their money in maybe different asset classes, right? So I've
Yes.
gone to all these family office events, all these alternative asset events, and the rule of thumb is 35-5, and maybe it's
Hmm.
changing a little bit on the fives and fives. First 30 equities, the public market. Second 30 treasuries, as safe as it possibly gets. Yes, American debt is funny, but it pays, and everybody
That
continues to buy
5.5
it.
is great.
I'll take it. 5.5 on a big number pays salaries and can pay for your year. 30% real estate, and that seems to be even better than most investments, depending on where you
Yeah.
bought it and how long ago you did buy it. It seems to be incredibly stable because, there's only so many waterfronts there could possibly be because there's not going to be more waterfronts, even though some waterfronts in probably 100 years will be a little different, maybe
Yeah.
a
It'll
little
change it.
separate. But the last two 5% is private equity, ETFs, and then risky investments in the angel world or some bizarre alternative investments that we're still trying to even comprehend what some of these other alternative investments even are.
Right. And you're doing great. You're going to all these family office events, you're traveling, and you're learning so much that we are all tech. We're second generation. And if you're anything beyond that, you weren't in the tech world. So you're meeting people who made money in chemicals, in textiles, in real estate,
Generations
generations,
ago.
multi generations. And so tech, what we do, which is our life, is still an alternative asset. Think about that. We're maybe 5% of someone's portfolio, but we have outsized PR. We make the headlines. It's the cool tech. It's the startups. Everyone wants to do it, but we're still such a small piece. We got big, and now we're kind of right sizing. But that's it. Most people shouldn't have more than 5-10% of their entire allocation in
Yeah,
this risky asset. But as you're meeting these family offices, and I'm meeting them as well, we're meeting and advising them, they're going to be the backbone of early stage investing.
yeah,
That's what I'm telling them, and that's what
I
they
agree.
want to be. Where, yes, they can deploy tens of thousands, hundreds, millions, and some of them will deploy 10, 50, $100 million and really anchor these GPs. But right now, and there's another chart I tweeted out, is emerging managers are taking a hit for a
Yeah,
few reasons. One, 2021, everyone raised, that was a huge issue. And unfortunately, those got false markups. They'll never exit. They'll never get liquidity. So, unfortunately, a lot of our friends and people that I met that we almost invested in can't raise their next fund. And so, we're the scouts of the industry, the angels, the emerging managers.
yeah.
They might raise 10, 20 million, but they can't live off of that if you're splitting it between one, two, three different partners. They are busting their butts. They're hustling out there. And without them, it's really going to hurt the early stages. They're the ones that take the risk, where it was like angels, friends, family, and fools. And so family offices are stepping up right now
Yeah.
and investing in them. And it's great. I love it because that is the lifeblood of our industry. These early founders that go to the competitions, that go to all the demo days, that go to all the universities, they're hustlers, and I love it. And the family offices are getting in, they're learning, they're co-investing, they're syndicating, and they will be the foundation of tomorrow's emerging managers, small sub 100, sub $50 million funds.
Let's just go back to the basics, and then I want to talk about family offices again. I like to remind people that these fund managers, GPs, are entrepreneurs in their own, right? So why do they
Yeah.
continue to raise capital? One is because they've proven themselves based off of prior investments that, hey, you should trust me with your money. I've done it before. I could do it again. But they also need a salary. This is how they make
Yes.
money. Angels, we don't make money per se, salary wise. We even get our healthcare paid for via doing these angel investments. But GPs do. So if you could break down what a fund manager makes. So if you raise a $25 million fund, can you even feed your family? I know it sounds like a big number.
Yes, you can definitely feed your family. I mean, maybe not in New York City, but let's do simple math, right? You have a $10 million fund. Traditionally, it's a 2 and 20 model.
Yep.
2% fees, 20% carry. 2% fees are every single year. So, of a $10 million fund, you take 2%, 200. So, that's $200,000 you can take of the 10 million every single year. But it's a legal entity. So, it's probably, we were using AngelList. It's setting up, managing all the finance and everything. It probably costs maybe $30,000 a year just to run it. So there you go. You're down to, then you have to do some marketing. So some events, everyone's always traveling to the Milkins, to Money Talks, all international. Great. Another 20,000 in travel down to, then you are maybe hiring an associate. You can maybe get an MBA intern. You got to pay them a stipend. You got to cover them. Great. I don't know, 5, 10. You got to do some type of, maybe, do you have an office? Who knows? But great. Down to, that's also minus taxes eventually. So you're maybe 150,000 at best. And you also then have to put in 1%, right? There's a GP commit. So of that 1% out of 10 million, that's, you have to put 100,000 in. So you're already 100,000 in the hole. It is capital call, so it's kind of spread out. But over the life of a fund, usually, and it's 2%, but if you're a smaller fund, you need that really more money. So maybe 2.5%. So you can take home 200, you deserve it. But over the life of a fund, you are raising 10 million, but you're only going to deploy 8 million. So everyone's
Yeah.
like, oh, wow, like I just have to get 50 million. Well, you got to do it with less money. So there's something called recycling. If you do get paid out sooner, an early exit, maybe some dividends, you keep reinvesting it so that you try and get to that $10 million, because the more you invest, the more you theoretically can make. But the whole upside, you're not going to get rich off of fees unless you really start stacking them and raise multi-billion dollars, is the
Yep.
20% carry. So you take 20 after your LPs get, depending on your LPA, your limited partner agreement, 20% off the top after your LPs get like 1x back. So raise a $10 million fund, you get 50 million, your LPs get their money back. Sometimes there's a hurdle like 2, 3, 4x you can raise and get more. But that's where you start making the millions. Oh, but wait, that takes 8 to 10 years. You deploy a fund over 2, 3, 4 years. So your first fund is, am I good at this? Can I hustle? Which is why you see a lot of first time funds just get into every deal, invest alongside every tier one to be like,
Hmm.
okay, they're onto something, they're there. You raise your second fund on maybe a few markups, but like, okay, you're good enough, I'll invest in the second fund. By the third fund, you need DPI. That's distribution paid in, which is, I actually made money. I gave money to my LPs. If you don't have
Yeah.
DPI by your third fund, that's the hot water everybody's in now, which is why you're seeing all these secondary funds pop up where they're buying out positions of illiquid companies just so they can pay out their LPs to show that there's worth there, even though it's lower than the valuation of the potential outcome. But I need money now, right? JG Wentworth, I want my money now.
It's
It's
my
been a
money and I
while.
want it now.
You got to prove you make money because I'm not going to give you any money and no one else will. It is really hard. As you said, they are founders, they are entrepreneurs, and it is not easy to be an emerging manager. So I will support them
Right.
till the end.
Yeah. I mean, you were talking as if there's just one GP running this. If you have two, cut
Correct.
this all in half. You have three, cut this in thirds. That's why I
Right.
made that egregious comment. Can you even feed your family? It's very difficult. Only raising, 10 million for dollar fund sounds
It's a lot
awesome.
of
Sounds like
money.
you've raised,
Right.
and it is a lot of money.
Yeah.
But that's where valuation of companies really do matter. So if you get in at 2.5 million, if you get in 5.5 million pre-money, that's why we are very strict about staying below 10 million pre-money
Yep.
valuation, because the difference between getting in at a 5 million pre-money valuation and a 10 million is that company goes to 100 million. We just made 20x opposed to 8x, which is a
It's a huge difference.
substantial difference. So when people are negotiating, it's about what you believe you could sell your company for. And so the family
Yep.
offices and these massive funds sort of have this weird threshold of how much they have to invest. What
Yep.
does that mean? They have to invest at least, some of them said we have to buy 1% of the company. we have to invest at least 5 or 20 million. And I go, why do you have to? They go, all right, say we make $3 or $4 million on, a $50,000 investment. Doesn't even, it doesn't do anything for us. So
Nope.
getting outright returns is also about how big your is and how big your family office net worth is. It doesn't even get you out of bed. Why would I even get
Yeah.
into the business if I only made 5 million? When if you just deployed 10x what an angel investor puts in, you just made 50 million. And that
Yeah.
is a changing number. That's a number that changes your family office. But if you make an extra 4 or 5, 6 million bucks, who cares? It's one of those weird things. I know these are massive numbers.
Yeah. And so usually a VC wants about 10% of a company. They'll pro rata and they want to maintain that over the course of the lifetime of a company, right? Keep betting on your winners. At exit, if I own 10%, you have to assume that every investment you make could be a fund returner. Like, oh, this
Yeah,
one will be nice, maybe a 10x, 20x. No, no, no. They have to be a fund
you have
returner.
to.
Every
The
single
whole
one. You
fund.
need the shots. Right. The whole fund at least. And if you just return the fund at 1x, that also sucks. And so, like, we just invested in the company. Yes, it's AI. It's cool. You'll hear about it, I guess, in a few months. But they had interest from a tier one VC, but the round was already, I don't know, 75% closed. And they're like, well, the smallest check I can write is 2 million. And they're like, well, there's only, I don't know, 750,000 left. They're like, sorry, the math doesn't work for us. Like, we need to own 10% of your company. Because when you raise again, we're going to get diluted by 10, 20, 30%. And we need the math to work that then we can then put in another 4 or 5
Yep.
million and maintain that. And then as you keep growing, we have more money and it grows. But it's interesting, right? If I make one investment and it goes huge, I have a 50, 60x. But then if I like dollar cost average, we're talking with like stocks, then I make like a 20, 30x, right? I change my basis as I kind of go up. So I deployed more. The absolute return may or may not be the same, but the multiple is all a game, right? It's a little bit of a game, so you have to kind of understand that as well. And it's fun when I'm talking to like founders. Do you understand the business model of your investors? Do you know how they make money? And it's
Yeah.
interesting when they don't. Like, you're taking money from people, you don't understand their expectations. Is it my job to explain it to you? And this is where
It's
the
almost
family
like
offices
blackjack.
are getting more.
Yeah.
Yeah, yeah, and this is where family offices are getting more sophisticated because they're like, "Oh, I'll get 5x." I'm like, "That's not venture capital. That's your traditional nothing, right? Nothing should get you 5x." If you do real estate, people are like, "Oh, I'll give you 30% of your money back." I'm like, "That sounds great, probably 99% of the world, but I'm
Yeah.
jaded. When I make an investment, I want 30 times my money back, even though the statistical like 3 sigma chance that I get it is so low. That's how we roll. That's the only
Yeah.
answer
I
I can
mean,
give people on Twitter.
yeah, it's like blackjack. Investors want to double down on their investments. I'd rather not find a new investment for years and continue to double down on ones that, are doing well. Because that's the way to make your money and keep your percentage. What I like about the family offices is expectations are slower, but they hopefully come with some sort of smart money. It comes with some sort of infrastructure, and they sure as hell know a lot of
Yes.
people who they could probably pull some strings with. And some of these family offices are bigger than you could possibly imagine and
Yep.
private and have, let's just say could create more infrastructure than a venture
Yep.
capital partner. And so what I think is fascinating about the venture capital world is, all right, one of the top tier venture capitalists, what they return to your money in 6, 7 years. What are you talking about? You're telling me I give you 100K, you're going to give me back 206 years, and that's a wild success?
It's
It's
really
mind-boggling to me.
it's interesting. So when you start getting to these billion-dollar funds, who is writing these multi-hundred million, 100 million, even billion-dollar checks? It's institutions, which are major banks. A lot of it are college endowments, like
Yeah,
the Ivy Leagues that each have 30, 50 billion each. Many schools have multi-billion. So like, oh, 50 million, 100 million. It's a few percentage, and they're allowed
that's
every
it.
year to kind of change what their allocation is. And so a lot of schools are major backers of all these VC funds. And if they can 2x their money, great, because Most of their private equity, other investments will get them 20, 30% a year. So a safer ish bet
Yeah.
because it's later stage growth. So it's also when you start deploying these later stage, they're closer to equity, to
Yeah.
exits, to liquidity. But it's also sovereign nations. Saudi Arabia is investing tens of billions of dollars into all of these funds. And
Yeah.
it's a way for them to park cash to kind of patriate it, and move it around, but also to get 2 or 3x, right? The 3x on the fund is phenomenal. Over the course of like 7, 8, 10 years, that's about 30, 35%. That's what you should be happy with. But yeah, I've met with some massive LPs like, if I get 2x my money, no one ever got fired for investing in Sequoia or in Andreessen, right? That's the other issue, is that why would you invest in anything else? If you are a money manager, invest in what's safe also. It's simple. If you take a risk, you could hit it big and be great. Would you make some more money? I don't know. And it's a J curve. So at first it's going to hurt. You're like, these companies aren't doing well. They're going down. Oh, yay. Hopefully this is going to work out. So that money manager, it's their job to make money, not to lose it, and it's a safer bet in a brand name.
It is weird feeling like a bet. Um,
Yeah,
it's something I wake up and do all day. Something I've been doing for 7 years. And am I going to make my investors substantially proud of me as compared to other investments? I go, if I could make you 6, 7 times your money, you should be, thrilled because I sure as hell am thrilled. It's a bizarre
yeah,
feeling when you're on the other side of the coin. I like to put it over here and say, I look at them as co-founders. I don't like to, feel like an investment. And some of my investors sure as hell make me feel like a deal. Some make me feel like a
yes,
human. And that's okay. That's okay. I mean, I'm a human and I put my, that to the side and I said, I needed their money to get this thing off the ground, to learn how to do this. So it's a weird phenomenon. By the end of the day, I am the largest shareholder and I
by
want to
far.
make
Yeah,
money too. So we all have the same incentive, but everybody has a different version of that incentive and a different perspective of what is success for them. If some are just trying to make 2 to 10x, if some want to make 1,000x, which obviously everybody wants,
please.
I just want to sell my business for, at least 3 to 4 times what my last valuation was at. Would that make my investors proud? Yeah, fine, maybe.
Yeah,
Would it make me a multimillionaire?
yes,
Absolutely. So, little
yeah,
different perspectives, and it gets exhausting to have to think about all of them. So I like to put mine first, and anything that happens beyond that now at this point is cherry on top because that makes my perspective. I hit my perspective of success when it comes to an exit. But then if I could hit my investors, and of course each one has a different because I have institutional investors, I have angel investors. Each one has a
yep.
different version of what they're looking for. If I could get what I want, it's a cherry on top to get what everybody else wants.
Yeah, and on the other side, well, as an operator who raised capital, like yeah, you have your somewhat beholden to your investors. Don't have maybe legal power, but they can annoy you, or they can be very
Yeah.
helpful, and strategic. But yes, I have my list of our 30, 60 investments. And I kind of go down like, hey, how are they doing? I follow up with them. I see what our last correspondence was. Like, okay, great. If you didn't send an update, maybe we can meet up, catch up. Like, where can I be helpful? How can I guide you? And so we just got an update from one of our investments that we invested in the C. They went out to raise a Series A. They're still building their product years later because their thesis has come a change. They had to pivot, and the update wasn't clear. So our dad and I have been annoyingly proactive with this founder because no one else pushes them. You
Yep.
have to say, great, that's an update, but like this doesn't make sense. Why are you thinking about it this way? Who did you get this advice from? Why are you deciding to focus on this? And a few of the questions and answers, like, okay, I should have thought about this. Like, yes, that was a learning moment. Actually, that's a great idea. Like, let's really like drill down into this because you have to earn the trust after years of just
Yep.
like getting updates and trying to add value, making introductions, doing PR for them. You have to kind of earn it back. Like, another investor just wasting my time. Like, okay, he just wants an update and like, okay, just to tell his LPs or go talk about it over
Yep.
dinner. No, I want you to succeed. Yes, selfishly, I want to make a lot of money, but like, this is what we love to do. We like to be like your pebble in the shoe. I want to annoy you in a way that no one else does because we care. And that is when you break through and they're like, great, okay. Sent back 3 paragraphs of like answers. Once it clicked, and I was like, great, I'm on your side. I'm here to help. And this is deep thinking, not just, oh, how are you going to make money in 6 months? That's when this is fun, when people say like they're in the trenches. And that's how you earn respect in this industry.
I like to be poked. It keeps me sharp. I
Right,
really, really like to be poked because I feel like I'm in somewhat more control than I've ever been in. So poke away. Obviously, don't be a gnat, but
right.
poke. That's okay by me. It's my obligation to report back to you. You were my early believer. I'm a believer in you. But just to bring this full circle, I'm running to here. So, back to the perspectives. We all see the same thing, but from a different point of view. One of my favorite, Bob Dylan quotes. If I could exit Series A plus, I'm in a really good place for me, my family, and my future. But does that put you and your funds in a good place for you, your family, your future? Because if push came to shove, if somebody wanted to purchase me at a Series A valuation, I'm only, pre-seeds, and I would be thrilled to do it actually after all these years of building
Yep,
this business. We're not going to be an IPO business. We're not going to be $100 billion business. We're not going to be $1 billion business. I still believe put in the right situation with the right partners at the right time because our market now is maturing. This could be $100 million, $400 million business. But am I the person to even bring it to that level? That's when, a lot of the time CEOs are replaced or the board, chooses somebody else to run and build the business.
yep,
So, and from my last perspective is if somebody purchased my business earlier than investors wanted to, at least I get to see my baby, hopefully in the right hands and
yep.
grow and grow. I will watch it. And hopefully, if I can negotiate and keep 2 to 3% of the business so I can keep a little skin in the game myself.
Yep. And so I've seen it go both ways, where after multiple years, again, offer, it's not the glorious offer of everyone's going to be super rich. The founder worked for years. You know what? They can get a few $1 million. They deserve it. Investors will get like 1.5, maybe 2x their money back after like 5 years. So,
Sorry.
like, yay, I got my money back. Like, I didn't lose it. It didn't work out, but like, I'm happy for the founders. And I've also seen where they had the same offer and the board said, no, you're going to keep working. You still have 2 more years of vesting. We think this can be bigger. Like, you have to keep going. And they fight with the founder. And it's like almost disheartening. We're like, okay, you raised money, Series A, Series B. You have a board. You answer to them. They have a lot of your company. They have the voting rights. And you are a startup, but this is a business. You took money from other businesses, other professionals, and you thought it was all going to be like amazing fairy tale, and that's the goal. We've had companies where boards have replaced the founders, and now where founders are fighting with their investors because of very high valuations. They got to do a recap. And what does
Mhm.
recap mean? We've done one or two, it sucks. And it basically means you get diluted down to not much. Basically, you get recapped out of the company. You got to like pay to play. And if you don't want to keep investing, you lose all of your equity. But like, if it's a recap, I keep asking people how many of those are successful. Almost none. But in this situation, it's called anti-dilution, right? So if I own 20% at 100 million, I'm still going to own 20% at a 10 million, but people have to invest more money. So it's causing a lot of issues. Would I give up my percentage? This is when people are just like, oh, I'm founder friendly. It's great to be founder friendly when money's free and no one cares and everything is awesome. But now we're starting to see, and there are cracks. People are fighting behind the scenes, and there's a lot of news over the course of this year that will come out as the information, other publications get wind of it. Just how difficult it is out there, and when push comes to shove, and when money over equity over power comes into play, you get to see who real people are and who are your
And
friends. Yeah.
that's why it's so important, and I'll toot our horns, is to hear both of our perspectives. And then we actually have the third and fourth perspective as well. One, we do the angel, where we don't report to anyone besides ourselves. Two, we're
Yep.
side by side with the venture capitalists who have to also report to people and have to feed their success and their futures. But then we come from the other two perspectives, the founder's perspective, where I'm going to be real. I'm going to tell
Yeah.
you, I'll take that Series A exit at this point. I guarantee it. Whether my board lets me take it or not, I will butt heads. We'll figure out when we get
Oh
there.
yeah.
And then the last perspective is that we're also a family office. We're more patient capital than most other folks. And we like to be that pebble in the shoe because, one, we have the infrastructure that we can introduce you to these folks because we want you to be
Yep.
successful. Two, we have the founders. We have angel investors for 20 years. We have highly successful exited people in our family, in our advisory, and as our mentors. So it's awesome to bring all these perspectives together. And that's literally why we're called the Startup Bros.
Now that's it. So let us know if you have any questions, family offices, exits, dividend out. Otherwise, you know where to find us. And we'll be back in the next week or so.
Sayonara. We'll see you again.